Hi everybody, thank you very much for joining us for this presentation on step-by-step inheritance tax and estate planning. I hope that you find it really useful. In a few seconds you'll see a disclaimer. Please take some time to read it before you continue on with the rest of the video. Thank you. Hi everybody, my name is Abraham Ace. I'm a Chartered Financial Planner with Atticus Financial Planning, and today we're going to be talking about step-by-step inheritance tax planning and estate planning. The reason I'm discussing this is because I spoke to a friend recently and he just wanted to know, what is it that we do? How can we actually help? He couldn't see the options that are available to mitigate inheritance tax and to leave assets to his children. So I went through the process I use mentally when I'm looking at a case, and he found that quite useful, so I'm hoping you'll find it useful too. Alright, so my first step whenever doing any estate planning is to create a will. And the reason for that is we create a will because that will form the foundation of any estate planning that you do and any inheritance tax mitigation. Why it's so important is, firstly, normally when you die that creates a lot of grief, a lot of sadness and unhappiness and a lot of confusion. What your will does is your will creates a straight path, a clear path for your assets to actually be distributed. And so that takes a lot of burden off people. It allows you to appoint the executor who's going to look after the distribution of your estate and the gathering of your estate. Someone who's capable of dealing with that difficult task, because it is difficult. It also, if you've got young children, allows you to appoint guardians and to set aside assets to help those guardians look after your children. And then, very importantly, it makes sure that money is put in the right hands. So a lot of people just assume that their partner will inherit everything regardless of whether they've got a will or not. But that's not the case. And if you don't have a decent will in place, you can actually leave your partner in a position where they're financially really in a poor situation, and you can create a situation where there's conflict, where there's struggling over who gets what assets. So the will is crucial. Also, putting in place a lasting power of attorney, very important. That just ensures that if you ever lose your mental capacity, there's someone that you trust who will actually look after your assets and look after your financial and your social circumstances, your welfare circumstances, with your best interest in mind, and you can trust them to do that. All right. Next step is to equalize the stakes. It's just simple process of making sure that there's enough assets in each partner's individual name to actually meet any bequests that they may have in their will. Then exclude any exempt assets. Some assets such as agricultural property and certain business assets and certain investments will qualify for exemptions and will be exempt for inheritance tax purposes. So it's worth just chatting to a specialist, making sure that they qualify, and then exempting those from your estate for inheritance tax purposes. Right, once we've got to that point, we look at gifting what you can afford to gift away. And our starting point with that is taking advantage of the exemptions that the government makes available to us. So there's the annual £3,000 allowance that each person has that they can gift away. And also another really important one is gifts out of normal expenditure. So under certain circumstances, gifts out of your excess income can be automatically exempt for inheritance tax purposes. And used properly, they can stop assets building up in your estate and ratcheting up your inheritance tax liability. So we look at those exemptions first. We then look at gifting away assets, capital, cash, etc. The easiest way to do that is to do that directly to the intended beneficiary, and you survive for 7 years and the value of that gift falls out of your estate for inheritance tax purposes. But some people want to retain control for various reasons over those assets, the gifted assets, how they're distributed, how they're managed. So we would also look at gifting away into trusts. And there's different ways of doing that, and this session is not broad enough to cover that. So just part of the gifting away what you can afford is gifting into trusts as well. All right, once we've gifted away everything that you can afford, we can then look at certain investments which qualify for business property relief. Now, business property relief basically says that if a company is a trading company and you've held the ownership of the shares in that company for more than 2 years, it qualifies for business property relief, and it's automatically exempt for inheritance tax purposes. Now, there are certain investments, certain AIM shares, certain startup companies, and certain unquoted companies which qualify for that business property relief. And as financial advisors, we have access to investments which are specifically designed to qualify for that relief, as well as the AIM portfolios which qualify for business property relief as well. And effectively what we do is we invest your money into them, and if you hold them for 2 years, they become exempt for inheritance tax purposes as they qualify for business property relief. And provided you hold them to death, you probably won't pay tax on inheritance tax on them, and you still have access to them, which is quite useful. So we look at exempting what we can using those, and then the last step, once we've done all of that, we look at, is there any excess inheritance tax liability, and we look to cover that with a whole of life insurance policy. Now, a lot of people balk at life insurance, but actually it's far more cost effective than people think, and it's a very efficient way of effectively prepaying your inheritance tax liability. And what we do is we set the policy up in trust so that when it pays out, it does not form part of your estate for inheritance tax purposes, and it actually does not rely on probate to be completed before that money can be paid out. So it actually provides funds to your beneficiaries which can be used to pay off any inheritance tax liability, or the majority of the inheritance tax liability that is still outstanding on your estate, which is very, very beneficial and keeps things very simple. All right, so that just gives you a step-by-step process. Create a will, equalize the stakes, exclude exempt assets, gift away what you can afford to gift away, look at investments which qualify for business property relief, and then wrap it all up with a little bit of whole of life insurance. It's a very, very simple step-by-step process. It's not going to work for everybody. It is a very complex area, and I would really, really recommend taking advice on it. So if this is an area you'd like to discuss further, please feel free to actually give us a call at Atticus Financial Planning, and we will more than happily help you out and talk you through the process step by step and in more detail and give you more information. Thank you very much for joining us today. I hope you found it useful, and have a great day. Thank you very much for joining us on the session on step-by-step inheritance tax planning. If you'd like any further information, our contact details are below. Please feel free to get in touch anytime. Thank you.